Hey, what's up? I'm going to tell you about an investment mistake you do not want to make. I've spent countless hours analyzing Uncle's ice cream business, and even though you might not want to invest in this particular company, these common investing mistakes can apply to you as well. Uncle's Ice Cream is raising money through the crowdsource investing platform Startengine. But should you invest? I did a deep dive into their Startengine documentation, SEC filings, and looked into their financials. Some of the highlights includes a whopping $13 million valuation with only $1 million in revenue. But they also have some exciting expansion plans. Is this enough to make it a good investment? Or is this one you'll come to regret? Let's find out. Uncle's Ice Cream is a Hawaiian ice cream sandwich brand delivering dozens of tropical and traditional flavors to stores across Oahu, Hawaii. After 9 years of wholesaling in Hawaii, Uncle's is now expanding to the mainland US with a nearly completed production facility in Las Vegas to provide distribution to the Southwest. I grew up in Hawaii and I've done many private company investments, and I've been working in venture capital space for years. So of course, with my Hawaiian roots and passion for investing in private companies, this deal definitely caught my interest. What is Uncle's target market? Uncle is targeting the ice cream sandwich market with a new approach. Uncle's is positioning themselves with the Hawaiian branding in contrast to a fairly sterile and unexciting market of generic store brand ice cream sandwiches. The ice cream sandwich market is anywhere between 1 and 3 billion US dollars, and Uncle's is trying to get a bite of that. Haha, see what I did there? So far, Uncle's makes around $1 million in revenue in Hawaii. In order to capture more of the billion-dollar ice cream sandwich market, they are now expanding to the US mainland by opening a new manufacturing facility in Nevada. They're raising money to achieve this, and they launched the Startengine crowdsource investing campaign earlier this year in 2022 to raise $1 million. As with any business, I started analyzing this company by looking at their financials, expansion plans, and then compared them with other companies in this space. So let's dive right in. Let's start with the balance sheet. In 2021, the company had a solid balance sheet with $205,000 in current assets and $200,000 in property, plant, and equipment, totaling the company's assets at $404,000. So from a first look, this tells me that they don't own their real estate where they produce their ice cream sandwiches. This is fairly normal for a company of this size. Compared to the year before, in 2020, this company had total assets of $388,000. So they grew their assets by around $16,000. On the other hand, the company has $109,000 in current liabilities, the majority of which is in notes payable and credit cards payable. In addition to that, they have a series of long-term liabilities worth $251,000, with the majority of which being SBA loans and a loan with First Hawaiian Bank, and this is part of their expansion plan to the mainland. This totals Uncle's ice cream business at around $360,000 in liabilities. For people unfamiliar with the term, this just means that they owe other people $360,000. This number grew by $10,000 compared to the year before. So to summarize their assets and liabilities, the company has $404,000 in assets, or things that they own, and $360,000 in liabilities, or things that they owe, giving them a surplus or total equity of $44,000. This is not uncommon for a company with their revenues. However, this is a company that has a valuation of $12 million. I would have liked to see an equity position of more than $44,000. But the story is not complete until we look at their profit and loss statement to see if the low amount of $44,000 in equity is growing or shrinking. So let's get right to it. For the year ending in 2021, the company had a total income of $1.18 million, most of which coming from their wholesale business. This number increased from 2020, where they had $787,000 in revenue, showing a healthy 50% growth in revenue. This is great growth, but it also should be taken with a grain of salt because that revenue growth was from 2020, which was the year of COVID. As you could probably imagine, COVID affected Hawaii a lot, and they had much less tourists that year. The year before that, they grew their revenue 30%, and other years were not included in the company's SEC filings, so I would have loved to look into that as well. The cost of goods sold was $711,000, which mostly comprised labor, or $281,000, and materials, which was $360,000. And materials, you could imagine, is probably the milk, the sugar, the cream, the flour, etc. Anything they need to make these ice cream sandwiches. So if we compare these two items, we can see that their gross margin was 35% in 2021. This gross margin is down from 2020, where they had a whopping gross margin of 41%. Even though this number decreased in 2021, this is a healthy gross margin for this type of business, especially when considering the Hawaii labor cost and the cost of materials. So this is a good sign. The operating expenses were $287,000, with the majority being payroll, rent, and utilities. Other expenses such as depreciation and interest total to $208,000. This is a fairly large number and is related to their expansion to Nevada. Other income includes the PPP loan forgiveness and totals $38,000. Although we should not take this into account in the coming years, as this item is only related to COVID reimbursements. If you sum up all the income and expenses, that leaves Uncle's Ice Cream with a net income of $14,000, and the total retained earnings of 2021 were $43,000. I will not go over the cash flow statement because otherwise this video will be way too long. Alright, there you have it. The key takeaway is this. The company made $1.18 million in 2021 with a gross margin of 35%. After operating expenses, they are left with a net income of $14,000 or a retained earnings of $43,000. So the net margin is less than 4%. This is fairly low in my opinion, but this can also partially be explained by the expansion to the mainland. The company took $186,000 in depreciation, and if the expansion hadn't happened, this would bring their net margin to about 11%. At these numbers, the company is valued at a 56x profit multiple or an 11x revenue multiple. This is a very high multiple number for manufacturing and wholesale businesses. And as you can imagine, a high multiple is usually not good when you're the investor. It is good if you're the business owner. From some quick research, I found a few ice cream companies on Biz Buy Sell with a revenue multiple of 1 to 3x and a profit multiple of 2 to 5x. I also did some research to compare them to other companies. So since most of their revenue comes from wholesale customers such as Whole Foods, it is a fair assumption to compare Uncle's to other consumer packaged good companies. These companies are also called CPG companies. Over the last 3 years, CPG companies were averaging an enterprise value to EBITDA multiple of 12x. This means that they had a total enterprise value of 12x of their EBITDA. Fairly straightforward, right? In addition to that, a study by NYU shows that for food processing companies, the enterprise value to sales ratio averages around 2.2x. And they also found that in the 92 companies that they serviced, the industry had a net operating margin of 13.6%. So what does all of this mean? This shows us that Uncle's 11% operating margin is in line with industry average. So that's a good thing. However, their revenue multiple and EBITDA multiple is much higher than industry averages. And with much higher, I mean that they're 5 times higher than the rest of US food processing market. This means that the company is 5 times more expensive than comparable companies. And the only reason how this is justifiable is if the company can show a ton of growth over the next 3 years. And that growth needs to be higher than 5 to 10 times to where they currently are. But can they do this? Let's look at their expansion plan. Uncle's SEC filing shows that they will use the funding in the following way. 40% will go towards marketing efforts around tasting programs, exposing products to customers through food festivals and events, and social media. 15% will go to working capital. This is used as cash runway and to weather any unexpected functions in their projections. 20% will go towards distribution, so creating a distribution system to provide delivery vehicles to cover the region, and 21% will go towards their Hawaii expansion. This will be used for expanding their Hawaii facility to expand across all Hawaiian islands. In my opinion, I would have liked them to use more of their money on distribution instead of the Hawaii expansion. I did not see an excerpt on how much money they're using for their Las Vegas expansion, and I would have liked that to be included in their documentation. In addition, they did also not list any of their projections for Nevada and Hawaii for the coming years. This is essential to tell the story of growth they are promising, right? However, with no projection, it is hard for us retail investors to make an informed decision and if they can really grow 10 to 50 times the size they currently are. So, after this analysis, here's a summary of what we learned and what my thoughts are. The company is making $1 million in revenue with a gross margin of 35% and a 14% net operating margin if we include the investments made into growth. The company gave themselves a $13 million valuation and effectively priced themselves with a 50x profit multiple and 11 times revenue multiple. On the other hand, comparable food processing companies are are valued at 2x revenue multiple and a 12x EBITDA multiple. This means that Uncle's is 5 times more expensive compared to other companies in that same space. The company needs to grow at least 5 times to where they currently are in order to justify this valuation. Uncle's is talking about big plans to disrupt the premium ice cream sandwich market in the Southwest, but hasn't proven that there is a lot of demand for Hawaiian flavored premium ice cream sandwiches. So in my opinion, there is a lot of uncertainty that they will get the same number of sales and premium prices compared to their Hawaiian distributions. Lastly, the company doesn't show a lot of plans about their expansion in Nevada. They claim that they have a letter of intent from Whole Foods to sell at 58 of their locations in Nevada, Arizona, and Southern California. This is great news, especially for the growth that they're promising. However, it has not yet been proven that their ice cream sandwiches will be a success in those locations, right? And Uncle's will be highly dependent on the Whole Foods market to sell their ice cream sandwiches. Plus, an expansion to 3 different states introduces a lot of complexity and distribution issues that the company previously only had to deal with on a very small scale on the small island of Hawaii. This will be different when they move to Nevada, California, and Arizona. A last concern that I have has to do with management and scaling. The management team is based in Hawaii. How will they manage Nevada? There's nothing in the SEC filings that mentions this. Will they be able to find good people to work for them in order to make this growth happen? Who manages the Nevada factory? And who manages their interstate distribution? Will the management team move over or stay in Hawaii? All these concerns were not addressed in their initial Startengine page or in their SEC filings. So because of all of these reasons, I am out and I will not invest in this company. Don't get me wrong, I am rooting for the management couple and they have a lot of good spirit and ambitious dreams, and that is awesome. I want them to spread the aloha across the US. I want to try the ice cream sandwiches here in California where I am. However, with the $13 million valuation and a whole lot of uncertainty and risk, I believe that this deal is just too expensive for me. I hope that they prove me wrong and that they grow into a hundreds of $1 million company, but only time will tell. And this is the investment mistake that happens a lot, not only with private companies, but also with stocks and crypto. We often hear about growth stories and the promise of making tons of money from an investment, but it is important that we look at the numbers and the data to see if this is a feasible investment that could realistically 5x, 10x, or even 100x. But yet we have to protect our downsides and buy the companies at a fair price. Quick disclaimer here, this is not financial advice, just my own opinion and my own research. So please do your own research when making an investment and feel free to invest in this company. All right, there you have it. Let me know your thoughts in the comment and let me know if I've missed anything. If you like crowdsource investing, check out this video where I cover a company that could potentially change the way we live and make housing affordable. Thank you for subscribing, and until next time, peace out.